Hey everyone, welcome back to the channel. Today we're diving into one of the most crucial concepts in trading, realized versus implied volatility. Let's break it down in simple terms, shall we? Alright, think of a car driving on a road. If it's cruising at a steady 40 miles per hour without sudden speed changes, that's low volatility. But if it speeds up to 80 miles per hour, suddenly slows to 10 miles per hour, then jumps to 100 miles per hour, that's high volatility. Now apply this to the stock market. If the price moves in a straight line with small changes, that's low realized volatility. If the price jumps up and down unpredictably, that's high realized volatility. Next, let's talk about the key difference between realized and implied volatility. Imagine you own a weather insurance business. Realized volatility is what actually happens with the weather. If it's stable, your payouts are low. If hurricanes hit unexpectedly, payouts are high. Implied volatility, on the other hand, is the forecast. What people think will happen in the future. If they expect hurricanes, they'll pay more for insurance, even if the storm never comes. In options trading, realized volatility is how much the NDX, Nasdaq 100, actually moves. Implied volatility, IV, is how much the options market expects NDX to move in the future. Now, how does an options seller make money in a slow downtrend? Imagine a casino owner. He makes money when gamblers overestimate their chances of winning. Now, let's say an options seller writes a contract expecting NDX to have big swings, high IV, but the market moves down slowly at a constant pace. Because the market is moving in a predictable, controlled way, low realized volatility, the options seller profits. Why? Because options were priced as if the market would swing wildly, high implied volatility. But that didn't happen. So, as long as the market continues in a steady downtrend, the options seller keeps pocketing the premiums. But here's where the game changes. Imagine you're riding a bike downhill at a steady pace, low realized volatility. You feel in control, no surprises, you're adjusting smoothly, making money. Suddenly there's a sharp U-turn. You weren't prepared for this move, you were expecting things to continue steadily. You have to react fast, slam the brakes and shift gears. This is exactly what happens when NDX suddenly reverses direction after a steady trend. The relationship between realized volatility and implied volatility shifts. The market moves more than expected. Options sellers who were making easy money now panic and adjust their positions, causing even more volatility. So why does this happen? Options pricing is based on future expectations, IV. When the market is predictable, realized volatility stays low and sellers profit. When the market surprises everyone with a big move or reversal, realized volatility spikes and options sellers are suddenly in trouble. To sum it all up, if the market trends steadily, options sellers win because realized volatility stays lower than implied volatility. But if a sudden reversal happens, realized volatility jumps, breaking the stable relationship with implied volatility. This leads to unexpected market movement, forcing options sellers to adjust, often at a loss. Alright, that's it for today. If you found this video helpful, don't forget to like and subscribe. Catch you in the next one.